Benjamin Graham, the mentor to the world's greatest investor and once the world's richest man, Warren Buffett, is known as the father of value investing. In his book, he shares his secrets to his investing principles. Warren Buffett describes this book as the best book about investing ever written. Here are the top 5 key principles from the book, The Intelligent Investor. Number 1 key principle: investing versus speculating. Graham distinguishes between investing and speculating. Investing involves thorough analysis, calculation of intrinsic value, and buying with a margin of safety. Speculating, on the other hand, relies more on psychology, such as FOMO, news, and short-term price movements. Meet John and Sarah. John carefully researches companies, analyzes their financial statements, and invests in businesses with solid fundamentals and promising long-term prospects. He buys shares of a company with a strong competitive advantage, steady cash flow, and a low debt-to-equity ratio, even if its stock price is temporarily down due to market sentiment. On the other hand, Sarah follows the latest stock market trends and invests in companies based on hot tips from friends or media hype without conducting thorough research. John is acting as an investor, while Sarah is speculating. Number 2. Margin of safety. Graham popularized the concept of a margin of safety, which involves buying stocks at prices significantly below their intrinsic value to minimize risk. By doing so, investors protect themselves against unforeseen events and market downturns. This principle helps investors avoid permanent loss of capital. Suppose you are building an elevator in an apartment. The elevator has a carrying capacity of 500 kilograms, which is about 7 normal-sized adult males. Would you want to go into the elevator with 6 people in it? No. You'd be worried that if that extra slice of pizza you ate might cause the elevator to break and all of you to fall to your deaths. The same principle applies to stock market investing. If company ABC has an intrinsic value of $100 per share, you won't want to buy it close to $100. You want to have a margin of safety to allow for unpredictable factors that influence the price moderately. If the stock is now trading at $70 per share due to market pessimism or temporary setbacks faced by the company, you will have a margin of safety of $30 per share. This ensures that even if the stock price fluctuates or the company faces unexpected challenges, your investment is still protected to some extent. Number 3. Mr. Market. Graham uses the analogy of Mr. Market, an erratic business partner who offers to buy or sell shares at different prices every day. Instead of following Mr. Market's emotional whims, intelligent investors should focus on the underlying value of the business. They should take advantage of Mr. Market's mood swings to buy low and sell high. Imagine Mr. Market as a business partner who visits Sarah every day offering to buy or sell ABC Inc. At times, Mr. Market is overly pessimistic, offering to sell shares at a low price. Other times, he's overly optimistic, offering to buy ABC Inc. at a markup. Sarah, the speculator, becomes excited when Mr. Market comes to buy the stock at $150. Thinking the stock must have a bright future, she decides to not sell and borrows more money so she can buy more to get rich fast. After a few weeks, Mr. Market came back to sell the stock for $50. Sarah panics and starts wondering if the market is in a bubble and will crash very soon. She sells all her ABC stocks in a frantic. Sound familiar? Don't let Mr. Market's mood swings sway you into buying high and selling low. Number 4. Quality over quantity. Diversify. You must diversify, they say. What does this mean? It means not putting all your eggs in one basket, otherwise all your eggs will shatter when the basket breaks. Great. Then does that mean you should buy as many stocks as possible? No. Graham suggests that investors should focus on the quality of a company, rather than the quantity of stocks they own. Rather than having 100 stocks you barely know, you should aim for 10 stocks that you know really well and have strong beliefs in their business fundamentals. Looking at Warren Buffett's portfolio versus S&P 500, he focused his money in a handful of great companies instead of spreading it thin across hundreds of companies. This is his portfolio in 1995. He had 86% of his funds in these 7 companies. Then in 2001, 71% in 4 companies. And now in 2022, 40% of his wealth is in Apple. Following the principle of quality over quantity, he was able to outperform S&P 500 significantly across history. Number 5. Emotional discipline. What is the most important feature of a successful investor? High IQ? Being a math genius? Knowing insider information? Well, this one maybe. No. Graham says the key to success is one's emotional discipline. He warns against succumbing to fear or greed of Mr. Market, which can lead to irrational decisions and poor investment outcomes. Intelligent investors should maintain a rational and disciplined approach, sticking to their investment strategy even during periods of market volatility. Suppose you want to buy a Ferrari F8 and you know the price of a Ferrari is $300,000. The next day, the price becomes $150,000. Would you not buy it because the price has gone down? Absolutely not. You'd be running to the bank immediately. Similarly, during a market downturn, while some investors panic and sell their shares out of fear, you should remain emotionally disciplined. You should reassess the company's fundamentals, and as long as there is no deterioration in its long-term prospects, instead of following the herd, you should stay true to your investment thesis and hold on to your shares, knowing that short-term market fluctuations are temporary and focusing on the company's underlying value. Eventually, as market sentiment improves and the stock's true worth is recognized, your disciplined approach pays off with profitable returns. There you go, 5 key principles from the book Intelligent Investor. Careful analysis of the company, having a margin of safety to protect yourself against unknown factors, taking advantage of Mr. Market, focusing on quality of your stock portfolio over quantity of stocks, and staying emotionally disciplined during market ups and downs. See you next time.